Today, we're going to do something that, let's be honest, might sound a little impossible. We're going to make the US tax code actually make sense. Now, we're not looking for sketchy loopholes here. No, we're applying a strategic top-tier consulting framework to help you understand the system, make way smarter financial decisions, and legally, ethically reduce your tax burden.
So here's our game plan. First, we'll define the universal challenge of taxes. Then, we'll introduce a powerful 4-part toolkit that is absolutely going to change the way you think about your finances. We'll do a deep dive into each and every tool, and by the end, you'll have a crystal clear financial bottom line and a totally new level of confidence.
All right, let's start with the core problem. The tax system feels, well, it feels intentionally complex, right? And that complexity creates a huge challenge for every single one of us, from regular folks to the biggest corporations out there.
And that leads to the question that keeps a lot of us up at night. Are we overpaying? I mean, without a clear framework, it is so easy to leave money on the table. The system's complexity almost guarantees that tons of people are paying more than they legally need to. So today, we're going to give you that framework to answer this question with real confidence.
So how do we solve this? Well, the answer isn't memorizing thousands of pages of tax code. It's understanding the core tools the government has intentionally created to encourage certain behaviors. You know, things like saving, investing, or buying a home. This is your tax benefit toolkit, and it is designed for financial efficiency.
So, what exactly is a tax benefit? The best way to think about it is like a discount on your taxes. Some discounts reduce the price of an item before the tax is calculated, and some are applied to the final bill. Both save you money, but as you're about to see, they work in very, very different ways.
This right here, this is our toolkit. And if you want to get all consultancy about it, this is what we call MISI, mutually exclusive and collectively exhaustive. It's a fancy way of saying every single tax benefit out there fits neatly into one of these 4 categories, and only one. This framework gives us an incredibly powerful and methodical way to analyze any tax situation and just cut right through the complexity.
Okay, let's start with the most familiar tool in our kit, deductions. When you think about saving on taxes, this is probably what pops into your head. Their job is simple but really important, to lower your taxable income, which is the amount of your money the government can actually tax in the first place.
Every taxpayer gets to make a strategic choice right here. You can take the standard deduction. It's simple, it's a fixed amount, no paperwork. Or if your eligible expenses, we're talking things like mortgage interest, state and local taxes, or big charitable donations, if they add up to more than that standard amount, you can itemize. It's a purely mathematical decision. You just choose the path that gives you the bigger number. Simple.
Now listen, not all deductions are created equal. Some, which are called above-the-line deductions, are so powerful you can take them even if you also take the standard deduction. These are often there to get us to do specific things the government wants, like saving for retirement in an IRA. And look at this example. A $2,000 deduction doesn't just reduce taxable income by $2,000. For this person, it actually pushes them over a threshold into a lower tax bracket, saving them even more on the rest of their income. Now that is a huge strategic advantage.
Deductions are powerful, for sure, but our next tool is on another level entirely. Tax credits are so often misunderstood, but they are, dollar for dollar, the most potent way to save on your taxes. If deductions are like chipping away at your taxable income, credits are a direct strike on your final tax bill itself. Okay, this is the most important distinction to understand in this whole explainer. A deduction reduces the income you get taxed on. A credit reduces the actual tax you owe. Think of it like this. A deduction is a coupon that lowers the price of an item. But a credit is like a gift card that pays for part of your final bill. One's a discount on the input, the other is a payment toward the output. This is an absolutely critical concept.
Let's put some numbers to this to make it really concrete. If you're in the 22% tax bracket, a $1,000 deduction saves you $220. Hey, it's a nice savings, you're happy to have it, but it's not the full $1,000, right? Its value gets diluted by your tax rate.
But now, let's look at a $1,000 tax credit. If you calculate your taxes and find out you owe the IRS, say, $1,500, that credit reduces your bill to just $500. You've saved the full $1,000, doesn't matter what your tax bracket is. This is why finding credits you're eligible for, like for having kids or for education, can be a total game changer for your finances. And there's another strategic layer here. Some credits are refundable. This means if the credit is worth more than your total tax bill, the government actually pays you the difference in cash. They're often designed as social programs. Non-refundable credits, on the other hand, they can only reduce your tax bill to zero. Any extra value beyond that is just lost.
All right,
let's look at the last two tools in our kit, exclusions and shelters. Now, these might sound advanced or maybe even a little intimidating, but you are probably already using them without even realizing it. And they represent some of the most powerful long-term wealth-building strategies out there.
An exclusion is the purest form of tax benefit there is. It's income that, by law, is never taxed. It doesn't even show up on your tax return as income. The classic example is the money your employer pays towards your health insurance premiums. That is real compensation you're receiving, but it's completely invisible to the IRS.
A common exclusion that a lot of people use for financial planning is the annual gift tax exclusion. In 2024, you can give up to $18,000 to any single person, and that money is completely excluded from the tax system for both you and for them. It's an incredibly powerful tool for transferring wealth without creating a taxable event.
You know, the term tax shelter can sound a bit shady, right? Maybe like something from a movie about offshore accounts. But in reality, it's just any legal account or investment that's intentionally designed for favorable tax treatment. And the key word there is legal.
And here's the big reveal. Some of the most common financial tools are actually powerful tax shelters. Your employer's 401k? That shelters your retirement savings from taxes in your peak earning years, letting it grow tax-deferred. Municipal bonds, which fund public projects, they give you tax-exempt interest income. These aren't obscure tricks. They're mainstream investment strategies, basically endorsed by the government itself.
So we've just covered the entire toolkit. Deductions that reduce your income, credits that slash your bill, exclusions that make income invisible to the IRS, and shelters that protect your investments. So what's the big takeaway from all this? The bottom line is this: these are not just terms for accountants. They are 4 distinct and strategic levers that you can pull to build a much more efficient financial life. Just understanding the difference between reducing your income versus reducing your final tax bill, that's the fundamental first step towards smart financial planning and really taking control. And that is the real power of this framework. You're no longer just a passive taxpayer, hoping for the best each April. You are an active, informed strategist. You're now equipped to have smarter conversations with a financial advisor, to evaluate opportunities more intelligently, and to take control of your financial future. So the only question left is, which tool will you explore first?